The biggest expense you'll ever make is likely to be a house, and for most, that means they need to get a mortgage. What may seem strange to you is that you can save money on a mortgage without refinancing. In fact, things like homeowners insurance, taxes, and mortgage insurance can be revised, and each of these things can make a difference in how much you have to pay. On this video, we're going to review 8 strategies you can use to reduce your mortgage costs. However, don't expect them to be a quick solution. Each of them requires great efforts on your side, so be ready for that. 1. Shop around. You never want to jump on the very first mortgage you're offered. You want to look around for the lowest rates. This is going to lower your payment, and it's going to mean you pay less overall. The key is to ask the potential lender for information about what they can offer. A credit union will generally have lower fees overall than banks. Some of those they keep for themselves, and some of those they pass along to you. Plus, they tend to work more with people who don't have the highest credit scores, which is always a benefit. We'll take a look at 3 different loans, with 3 different interest rates. If you're getting a mortgage for 30 years, at a fixed interest rate, for $250,000, you'll want to know what the rates are going to mean for you, right? So, let's take a look at 4.75%, 4.5%, and 4.25%. Each of these are going to make a big difference, though the numbers don't seem like much. You want to know the difference between different lengths of mortgages and different total interest rates. That way, you can take a look at what your differences are going to be in costs. Keep in mind that homeowners insurance and taxes will still be the same no matter what other terms you have. 2. Pay more down. Down payments are extremely important when it comes to your mortgage payment. You'll be taking a large portion of money right off the top, and that's going to mean less you owe over time. Depending on your loan type, if you have to take out 90% of your total house costs or 95% of your total house costs, you're going to notice a big difference. Also, FHA loans require you to pay mortgage insurance for the entirety of the loan if you only put down 10% or less. A larger down payment means that you don't owe as much on the total principal of your loan. That means you're going to have less interest and less mortgage insurance to pay as well. Then, over the long term, you're going to be able to get rid of the mortgage insurance or pay off the loan entirely much faster, saving in total. 3. Interest-only mortgage. An interest-only loan means that you pay just that, the interest. You start out with the short phase where all you owe on the loan is the interest, and then, as you get to phase 2, you pay the principal and interest. With this type of loan, you could have a 30-year mortgage that's broken into phase 1 for 5 years and phase 2 for 25 years. That means your first 5 years you have a low monthly payment because you only owe interest. The next years you have to pay off the balance. These can help you get started with your mortgage if you don't have a whole lot of money to start with. 4. Get your taxes reassessed. Have you ever looked at how much of your mortgage payment goes into escrow? You also want to look at your annual tax assessment. The tax assessment lets you know what the value of your property is supposed to be. From there, you can check the tax assessor's website to find out more about similar properties. Look at what those houses are worth and valued at. If they have a lower assessment, or if you have a record of similar houses selling for less, you may be able to get a reassessment. Now, the assessed value and the appraised value of your home are different, so make sure you keep this in mind. A tax assessor is going to give you a completely independent value. Then, it's up to the collector to accept or reject it. There is recourse, however. If you find that your collector won't reassess, but you have evidence that the current assessment is wrong, you can file a complaint. You'll need to go before the Board of Equalization for your state to get things sorted out. 5. Lower your insurance payments. If you're paying escrow, then you're paying homeowners insurance out of that account. It's extremely important that you continue paying your insurance, but you may not have to pay as much as you are right now. Get quotes from other companies that offer homeowners insurance in your area to see what's out there. Then, you want to make sure you compare what they're offering to what you have. Choose the one that's going to give you the best value for your money and cancel the old insurance. Then, make sure to let your mortgage lender know about it. Now, if you're interested in sticking with your original lender, you do have the option to evaluate your policy. Look for areas that you might not need anymore, like coverage for items you no longer have. Look for ways that you can get discounts, such as that security system that you installed, and then look for any extra coverage that you might not want. Any kind of changes in your home could be grounds for different coverage. Not to mention, you could get a discount just for professional memberships that you have. You want to let your homeowner's insurance provider know about all of these things. 6. Look for additional discounts. If you have a financial hardship, you may be eligible to lower your mortgage interest. You'll need to approach your lender and apply for a loan modification, or you can approach the Home Affordable Modification Program to do it. Either way, you have to make sure you submit the forms and then show that your current mortgage payment is too high for you to make. You'll also need to prove that you can't refinance your loan, but at the same time, that you can afford your mortgage if the interest is lowered. 7. Build up your credit score. The best way to keep your mortgage payments down and your interest rates down are to have a high credit score. When you get any kind of loan, the lender is going to look at how creditworthy you are. A higher credit score makes them feel more secure and more likely to give you approval and a lower rate on the loan that you're looking for. Just make sure you pay attention to each of these different aspects of your credit score. On-time payments. Paying all of your bills on time keeps your score in better shape. If you miss making payments, or you're late, or you get collections on your account, you end up with a black mark on your record. Low credit utilization. Keeping the total balance of your credit cards down is going to give you a better-looking report. It looks to the lender like you know how to manage your money, and that means you get your credit score up. Consistent work history. This is one thing that's actually listed on your credit score, and your lender wants to see it. They want to know that you've been at the same place for a long time, and they definitely want to know that you have a steady income. These things make you a better risk overall. No collections. If you can get rid of a collection from your credit report, it's going to look a whole lot better overall. Paying off that collection won't help, but look for methods of removal. 8. Refinance your home. If you already have a house and a mortgage, you may want to look into refinancing. This is going to help you get a lower rate, and it's going to help you cut down on your payments. You just want to make sure that you're shopping around and looking for the best options before you get started. Some lenders are offering even better rates than others, and you want to take advantage of them. Look at each of the other factors we've talked about as well, because even though they're primarily for first-time buyers, you can absolutely use them if you're going to refinance an existing loan as well. You'll want to check whether the fees associated with refinancing are worth it to you as well. On the bottom line, when it comes down to it, you'll need to find ways that you can lower your payments as much as possible. By lowering interest and increasing your payments, you're going to find that you have a much better outcome, and your financial situation is much better overall. That's it for now. On our website, you can find more posts, as well as calculators and other financial tools. Do you have more ideas to reduce mortgage costs? We would love to know your thoughts, so feel free to share them with us in the comments below. I hope you enjoyed it, and don't forget to subscribe to our channel to get the best financial videos for free.